In a survey released by Ernst Young today, it's a regular one of their surveys, indications were that the banking confidence index has risen in the first quarter of 2012, following gains in the last quarter of last year. Survey found that confidence rose in both the retail and corporate segments of the market. Joining us now for a look at the survey and more is Emilio Pera, who's lead banking and capital markets director at Ernst Young. Hi, Emilio.
Good afternoon.
You know, we've said on the show that there are a lot of indicators coming in about growing confidence and growth. Possibly towards the end of last year, there was a bit of desperate optimism. Now it seems that the indicators are saying, no, it's real. There is recovery here. And that, of course, then develops its own momentum because people feel better. New car sales is one thing. Surely banking is another because they took a bad knock and things are looking better. So before we go into the sector elements, big picture, what's happened?
I suppose, as you correctly say, towards the end of last year, it was the hope more than the reality. What we've seen through the results released by the banks is that, especially on the retail banking side, definitely a much better performance in the year that's passed. On investment banking, it was still debatable. There was some uncertainty in the market, very volatile year throughout the year, and also not as confident at the close of 2011. But what we're seeing now is that positive sentiment is
just remind us how it works, how this index works, because unless one knows that, it's a piece of string.
Absolutely. It's a survey conducted by the Bureau of Economic Research in Stellenbosch. It's done, as you mentioned, on a quarterly basis. It's an interview of the banks, but going down to a product level, and it's focused on retail banking on the one hand and investment banking, and then in addition to that we also do insurance and asset management.
So is it what people feel, or is it numbers that have actually been produced by the banks?
Effectively, it's a qualitative survey, so not looking at the real numbers, but it is the questions that we ask is, do you see your profits increasing, reducing, or remaining stable? We look at that across the market and summarize or collate that results. And
so the number, the phrase you use is rebounded significantly, which suggests that it was low, but it's gone up by a lot. From 50 index points in the fourth quarter of 2011 to 89 in the first quarter, that seems like an unusually big jump.
Absolutely, and we've been conducting the survey for the last 10 years, and over the last 3 years it's been below the long-term average, and for the first time, as you say, with this significant increase in confidence, it's for the first time again above the long-term average of the confidence level.
And you say also the growth has returned to pre-crisis, that's profit growth, has returned to pre-crisis levels. I'm not seeing that noted anywhere else.
Yes, and effectively, as I mentioned, it's a qualitative review, but what we also do is we look at the real results ones that's released by the banks, and we have found a close correlation between what the survey shows and what we see in the market.
Let's look at some of the details of what you said. Is a turnaround in interest and non-interest revenue?
Yes, I think in looking at the makeup of the profits definitely changed over the last couple of years, and non-interest revenue has definitely become a much bigger driver of growth in the top line for the retail banks and also investment banks respectively. Fee
income too. Now that's always an issue with consumers, and there's been a lot about do the banks compete enough firstly, and secondly, as a sector, are our banking fees comparable and as they should be in relation to other countries? So is there positivity too about this?
I suppose you have to look at the nature of the products that is going into the market. It's not like home loans that has a longer date. It's shorter period term loans, personal loans. The fees of that are higher because of the risks that the banks are taking, and also it is a shorter term, so the administrative costs are higher. I think in looking at the overall fee environment within South Africa, that is always a hard debate. But I suppose you have to look at the competitive environment and also new players that we've seen and new innovation that is definitely impacting on the real cost per transaction.
Also impairments and losses, that was one of the big factors, of course, in the global financial crisis. A lot of burning of fingers. There will never again be 100% loans. Well, of course, they've come back a bit now.
Yes.
So the banks are recovering and they are confident again about lending.
Definitely, and if you look at the bad debts, definitely impairments have reduced and it's looking a lot more positive, which also means that banks can take on slightly more risk. But as you say, definitely, especially in secured loans, and if you look at home loans, and if you consider the property market is still under pressure, pressure. The 100% loans probably more the exception than the rule.
What about the unsecured lending market? That's been in the news a lot, and we've had two versions. The one is that, whoa, this is the equivalent of the property bubble of the mid-2000s. And they said, no, there's a lot of scope still here, but then there was a bubble and things burst. The other version is, let's look at the facts, and the unsecured lending is not dangerous.
Yeah, I suppose you have to look at it in the context of the total loan book of the bigger banks. It's a relatively small proportion, but it is growing very fast. So you have to consider that. It's also understanding the breakdown of that portfolio better. I think compared to where we were in the early 2000s, the governance around that segment has improved significantly, both from a National Credit Act, your extension of credit, but also in the management of that. So I think there are definitely lessons learned, but it is to understand that book, and if you look at what our regulator, it is to, at this stage, get a better understanding of the makeup of that book rather than at this stage say it is a bubble.
Costs and headcount, they are related. There's been unhappiness at some of the banks. I mean, Standard Bank, Jacko Marie described it as blood on the floor a few years ago.
Yes.
ABSA has been in the news. They say it's restructuring, but there's retrenchment. What are your surveys telling us about that?
On both retail and investment banking, there's a net increase in headcount. So that is definitely a positive indicator. So yes, certain banks might be going through restructuring or different cycles in right-sizing their businesses. But we've also seen significant growth, especially in the tier 2 banks, but also in certain market segments. And you mentioned unsecured lending. So definitely there's a need to beef up those teams in some banks. So at a net level, overall increase in headcount in the last quarter.
What should corporates and individuals be doing here, saying, oh, they're more confident, it's time to go and ask for a loan? Does this index have an effect?
I suppose that is the confidence that the banks have in the market. So definitely has an impact.
But it's reinforcing, isn't it? Mutually reinforcing.
Yes, but I think it's also, you have to look at the lessons learned over the last couple of years. And although profits have improved significantly, I think the banks, especially if you also consider the Basel III regulatory requirements that's coming down the road, in looking at the lending and the segments, secured and unsecured lending, where they'll be focusing, it would be in the back of their minds as to what the capital requirements are going to be under Basel.